Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Corbin Cook and Alex Swanston of Rise Run Capital. Max, what was the takeaway you had from our conversation with Corbin and Alex?
Well, I can tell you I'd like to invest most likely in a deal with Corbin and Alex just because they seem so aligned with our own investing strategy. It's cool that Alex, of course, I'm going to be biased here, but I like that Alex has a deep Q of E background. So he brings a unique perspective to their deal process, I think, wink, wink. But they seem super sharp. They're value investors. They recognize that you need to buy the company right on entry because that gives you room in case something goes a little squirrely right after acquisition. And they even say it always does, and they always, and pretty much everyone always will miss something in diligence in the lower middle market. So they're really unique. They're value investors. They are very hands-on. And I just like what they had to say. They talk about returns, and I think the listeners will find that very interesting. And the reason why the returns obviously need to be a little higher in this space for the risk that's being taken. But a great conversation. They're impressive. They've just recently 7x'd their first exit, and they've got a lot more things going on, a lot more irons in the fire. So it's a great conversation. I think the listeners are really going to enjoy this one.
I agree. Really strong interview, if I may say so. Thank you to Corbin and Alex. Really strong track record they both bring. Really a lot of experience and opinions. What struck me, among many things in this interview, was the backstory and the observation they had about other private equity firms in the lower middle market. Alex, in particular, had seen into a lot of deals as a Q of E provider, a lot. And so he had observed that private equity in general, there's a big disconnect with private equity broadly in the lower middle market. The bedside manner is lacking, he says. Private equity has a hard time understanding the messiness of the lower middle market, understanding relating to owners. And so they thought one of their key value props could simply be following through, doing, as Alex and Corbin would say, doing what they said they were going to do. Which sounds obvious, but I think the insight is I guess how few private equity groups do what they say they're going to do and follow through in the way that they've promised to when it comes to the lower middle market. So that surprised me. And apparently it was a great thesis because the guys just seem to be absolutely crushing it. Nicholas, what was one of your takeaways?
Well, before I jump into the takeaways, I agree this was a fun conversation. They have a lot of experience and a lot of opinions. They're not very charismatic. I actually crossed paths with Alex a long time ago. I think we learned that in the pre-call. I have email exchanges with him as far back as 2018. Even though I was what Corbin calls a single shingle sponsor, Alex, while he was a Q of E provider, took me out for lunch in early 2019. And this was a great opportunity to get to know him better. And then since then, of course, he's shifted from being a service provider to becoming a very successful sponsor. A couple of things they said, kind of tactical nuggets, stood out for me. One was on the timing of fundraising. And so I think we asked them, when do you go to investors? When do you go to capital providers when you have a new deal? And they said that they socialize deals very early on with lenders. And so they will take to their preferred SBICs deals that are maybe not even under LOI yet and take them to lenders to kind of check the appetite and gauge the interest level. And then they said for the broader equity pool, they preferred to wait until later in the process when the deal is more fully baked. And I'm thinking that's probably Alex and his Q of E background that prefers to do things in the right order. The other thing I thought was interesting was they said that there is always noise with deals that do very poorly, the 0x's of the world. This makes sense. And by noise, I think they mean just contentious, maybe even litigious. Not that they necessarily had direct experience at Rise Run, but through their extensive experience in the lower middle market, they said that deals that go to 0x can be contentious. But surprisingly, they also said that deals that do really, really well can be contentious. They said if it's a 10xer, you're going to have people get greedy, people thinking that there's too much money flowing in one direction or the other, even if it's stipulated like that, and people will get contentious about it. So they said that, a 3x is really where there's peace and quiet. Everyone gets what was stipulated. There isn't a lot of dispute and people move on. But with a very good outcome or very bad outcome, there's going to be noise. And that to me was an insight that I hadn't necessarily heard before.
Well, before we get to the interview, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average a commitment per month. So if you are a sponsor raising equity for your platform acquisition, submit your deal to us via the website at mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form also on our website for accredited investors. Fill that form out to be kept in the loop on future raises. That is at mindscapital.co. Here is the Minds Capital interview with Corbin Cook and Alex Swanston of Rise Run Capital. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Over beers at a closing party in Wyoming 6 years ago, Corbin Cook and Alex Swanston laid a plan that has since generated 5 platforms, very strong EBITDA growth across that portfolio, and recently, a very successful exit. After that exit, the snapshot of the portfolio today is 4 portcos and $40 million of EBITDA across those 4 companies. So not unlike how Nicholas here paired up with his Q of E provider and our third partner, Max Lummis, to form Minds Capital, Corbin partnered with his Q of E provider, Alex, to start the Dallas-based Rise Run Capital. Enthusiasts and students of the lower middle market, Corbin and Alex have had a very productive last 6 years as sponsors, which we are going to unpack over the next hour. Corbin Cook, Alex Swanston, welcome to the Minds Capital Podcast.
Thank you for having us. Thank you, Will.
So let's start with that good news that I just teased, guys. You had your first exit, a very successful one. Let's hear what we can about that journey with that company.
Yeah, I'll happy to kick us off. We are just FYI under an NDA, so we can't say certain things at this point, but we're happy to talk and generalities here and hopefully provide some context around the deal. It was actually one of our first deals a few years ago. And would you just like to hear the kind of the whole story, or
what did you? Yeah, let's get a sense of the size of business, whatever you can share when on entry, and then how you improved it, what you did with it, that led to a successful exit.
Yeah, I mean we're lower middle market guys, and for us, we try to stay in a pretty tight box, and that's kind of $2 to $7 million of EBITDA. That's where we define it at least. And yeah, this business was on the lower end of that range. It was an industry that we had some insight into just from some relationships we had. We call it a proprietary deal. It was well, when we receive a SIM document that comes in a Word doc, we chase it hard because we know nobody else is looking at it. So we got a Word document, and it just so happened to be in a space that we had, a little bit of knowledge in. And so we pursued it. We actually and there was another guy at the table. So we actually lost the brokered process. We came in second. Scrappy as we are, we kept following up, searching, for press releases on the deal, and just couldn't find anything. And so we just didn't think it had transacted. So we kept pinging the sellers. 6 months later, we started pinging the sellers just like a month at a time, calling them, emailing them. About a year later, Corbin, something like that. Yep. About a year of us completely annoying them with zero response, by the way. We were sending emails into a black hole. Like, we didn't hear a single thing from them. And all of a sudden one day they responded and they just said, look, you guys are tenacious. The deal didn't go through. We appreciate you continuing to follow up with us. Let's have a conversation. So at that point, there was no broker. It was just between us and the seller. And that's kind of how we kicked it off. I mean, classic kind of setup, at least for us. It's, guys in their 70s have evolved into being completely risk averse, right? They've started a business, they've grown it, it's become a lifestyle business, completely shut down reinvestment, sucked all dollars of cash flow out of it to fund their lifestyles. It was perfect setup. They hadn't grown the business in years. They literally, I mean, if you looked at the P&L when we bought it, it was very stable. It's a very nice business, which is very, very, very nice for us. But they hadn't grown it at all.
And so, understanding that you guys can't share a ton of details about the numbers of the acquisition, growth, exit, can you give us anything about how much you grew it over your ownership?
Yeah, I mean, the business basically 7x'd over our whole period. So I think, financially it's 7x'd.
7x'd. Great. And so what were some of the key levers in that growth?
Yeah, I mean, a little bit of that was some M&A. We did one add-on, and that was sort of incremental. It was probably about 10% of total EBITDA at that point. So didn't drive anything, but it got us into some new customers. The growth was driven. I mean, it's a kind of a multi-site business that had been just kind of collecting rents, I'll call it, for many, many years, which is why I made it so stable. Very, very sticky revenue. The problem is it costs money to establish new footprints in new places. And so the sellers were just not interested in that, right? So every time they put out $1, they had to wait, a year or two to see it back. And that just wasn't exciting to them anymore. Now to us, if we can see, a 12 to 18, 24 month return on every CapEx dollar spent, it's really, really high ROI CapEx. And so we just literally released the spigot. We, kind of realigned the culture around a culture of like, let's just keep this thing stable, to a culture of growth. We had pre-transaction, we had, basically given the general manager a shot at becoming the CEO, just after we had met with him a few times and gave him a shot and said, look, we are hyper focused on growth and we're going to give you all the tools you need. We're going to hire real salespeople. We're going to put real processes in place. We're going to track and measure all these things to keep you and us accountable. And so it took us, I don't know, about a year, Corbin, to get all that kind of like dialed in and right. And then after year one, it was explosive. We just did exactly what we said we were going to do, and everybody executed, at a high level. Yeah, and we over that time, I think we 7x the business, we 7x the footprint too. I mean, the footprint grew from a handful of places to a bunch of places. So,
well, just to piggyback on what Alex had said, that the risk aversion of the founders was trickling down throughout the culture, and so immediately upon closing the transaction, we flew there, rented an Airbnb, and essentially for 2 weeks we paraded in every functional area to a dining room. And Alex and I said, listen, give us the good, bad, and ugly of everything you've seen over the last 35 years. Where have the founders allowed you to grow? Where have they kind of hampered your growth? and we whiteboarded the next essentially 4 or 5 years of the company's growth. So the not only was it a financial hindrance to the company for the risk aversion, but also from a cultural standpoint. So Alex has called it Liberation Day. Now this is before Trump's Liberation Day. This is the good Liberation Day.
Sadly, that's a tainted term
right.
now. But
yeah. So Alex coined that term way before the president did. So yeah, so that was the main driver, Will, of the growth of the company, and obviously it was a great outcome for everybody.
let me press on it, guys, because on the one hand, it makes sense. On the other hand, the fact of retiring owners who've rested on their laurels, gotten conservative, that's a classic pattern, and yet it doesn't yield 7x growth. So there must have been something more, and what I suspect is that it was this process, this almost intimate process where you bring everybody through the Airbnb and you're whiteboarding with everybody, and just doing this incredible audit, getting everybody's opinions, and just have that kind of rigor to do that, and showing the employees, I guess, the respect too of wanting to hear everybody's opinions. Although, as I hear myself say all this, like even that doesn't sound. We've heard things like that before, so it's still there's something more special about this to generate such growth. And by the way, just to point out, like to see 7x, that's almost all organic. You said you'd done one more acquisition, but the attribution of that revenue or that was only about 10%. So to 7x almost all organically. I mean, it's just really remarkable. I don't know. I respond to that if you would.
Well, it probably goes back to a realignment of culture. And then also, I mean, you guys have a great podcast here and you speak to a lot of sponsors, and not to speak poorly of other sponsors, but, it's one thing to say what you're going to do with a portfolio company. It's another thing to execute and to really follow through and be intimately involved with the operations of your portcos. And I, not to toot our own horns, but I think Rise Run does a really good job of that.
Yeah, it's interesting when you get everybody in a room, people that you don't know, you're the new owners. You get a lot. The amount of people like hugging us and we're so grateful that you're here. Like we have so many ideas that were just squashed right from the sellers over many, many years. Like these people were so dedicated to the company. They wanted to see it grow. They wanted to be a part of it. And they were truly happy that we were there and we were going to allow them to try things that, may or may not work, but they're at least going to get to contribute right into the value creation process of the business. I mean, it was unique because we've done that again. Right. We've done that again, but the feedback and the reception and the interactions were just not the same. These people were so attached to the company, like just the employees. It was something different. And look, the industry, it's basically a very small industry, right? We had a competitor that was asleep at the wheel, a public company, basically. That was our only competitor at the end of the day. And they were asleep at the wheel. And we sold a product, right? And, effectively a commodity but it was the service. Everybody says, well, you sell a product. We didn't view ourselves as selling products. We viewed ourselves as selling services. And the services are what made the company so successful. I mean, it was 100% service-driven organization. Well, at the end of the day, we did sell something. But in order to sell that thing, it was all the service and infrastructure around that service that made it so successful, which is also what we did really well. Everybody else did really poorly. And so we just built around that culture of service, which was a phenomenal culture of service. We had nearly 100% uptime on everything we did over the course of the whole period. Just things never broke. People were super happy. Their customers were super happy. Channel partners were super happy. if they didn't ever have to, if they ever even had to think our name, like if they had to say our name at all, we'd done something wrong. We didn't even want them to know we existed. We just wanted to make them money. And if they had to call us, something had gone terribly wrong. And so, and the revenue is super sticky in the space. And it's so, if you can just keep things working, hang out in the background, and you just literally collect coupons. It was amazing.
And that sounds like it was a lot about retention. But it also sounds like this multi-site business that you grew the number of sites. Were you stealing market share, or were you creating new market?
Both. In fact, Corbin, would you say most of our growth came from taking market share?
Yeah, I think the vast majority of it was probably taking market share, and then and it really gets back to what Alex was mentioning, is service and being responsive to the customer. And so yeah, it was a great outcome. And
so this was a case where you could call on a prospective client who is with your competitor and say, "Hey, give us a shot," and they'd say, "Oh, please, because our current provider's terrible."
Yes,
that's right.
Exactly.
Yep.
The dynamics in place here as you entered the business, right? You have a competitor, a large public company, who's asleep at the wheel. You have a seller who's in his 70s and risk averse and unwilling to reinvest anything for growth. And you have employees who are oppressed, waiting for Liberation Day. Like, how do you identify all of these success factors on the front end when you are screening a business?
Well, we knew about two of the three we knew going in. I mean, that was part of our thesis. The third, which we did not expect, were the employees, the oppression that was happening at the, in the business. It was very strange. I mean, we weren't really even allowed to interact with the employees pre-transaction. They were very sheltered about everything. We would be there for a meeting before anything ever closed, kind of diligence meetings, and we would get pulled to the side, like, hey, you got have secret meetings on the side when everybody else was breaking, like, hey, we're so happy you're here. You guys need to buy this company. We're like, it's never happened before, and I don't think it'll ever happen again. So, I mean, we didn't obviously expect that the employees would be super enthusiastic about new ownership. As we had anticipated. And then just the ideas that came and the commitment, it was just, it was special. Yeah.
It sounds like so much fun to rent an Airbnb for 2 weeks and have an ongoing workshop with all the employees coming to sit around the dinner table. Can you share more about this? How did you structure it? What was the content of these workshops? Is this something you've done for other deals as well?
We knew that we had to be on site and looked up hotel rates, and they were a lot higher than renting a house. So trying to keep our expenses low for our LPs. But yeah, I wish we had designed this even better, but we rented the house, and the first, day or two, you would have, operations people, shipping, accounting, finance, and, you would whiteboard, but then a couple of days later, you'd invite them back and say, okay, you mentioned something, 2 days ago. Let's dive into that a little bit further. I don't know. A lot of our companies are in Texas, so we simply probably don't need to do that. But I think going forward, we'll definitely utilize that because it gets them out of the office, right? A lot of lower middle market companies, their offices are not the most glamorous places to have a meeting. And then it's probably more intimate setting where you have 10 people around a conference table at an Airbnb. So yeah, it worked out well. I wish we had a better idea, but it just kind of turned out that way. So
we have taken that playbook. I mean, we haven't continued to rent the Airbnbs just because it just worked out that way and on that deal. But yeah, I mean, every post-transaction deal starts the same way for us. It's the same feedback gathering process, getting to know everybody that's working in the company, seeking feedback. I mean, we actively want people to provide input, like good, bad. What's the good, the bad, and the ugly, as Corbin said? What do you like? What do you hate? What can we be doing better? What tools do you need to do better? Do we need to hire people? Do we need to fire people? We go through everything with every functional department within a business that we buy, and we kind of, we whiteboard all that out. We then synthesize all that information. We then use that to develop kind of the 1, 2, 3, 4, 5 year long-term roadmaps. And obviously we tweak along the way, right? We revisit, and nothing's perfect, but that it lays the groundwork for the hold period. I mean, it lays the groundwork for everything.
You mentioned, without throwing other independent sponsors under the bus, that there can be a discrepancy between what you say and what you do. What are some examples that you've seen other sponsors say but struggle to follow up on in reality?
I think, Alex, maybe you can walk through, you have a whole range of sponsors these days, right? You have everybody from the single shingle guy all the way up to the lower middle market where they actually have a fund. We see a lot of folks come from, call it bulge bracket investment banks or larger private equity firms. They either become a searcher or independent sponsor. This world that we invest in is completely different than the upper middle market. And so when you say, what do sponsors do and don't do, it might not be a function of that versus they don't know what to do. Right. We're not getting pretty sims. We're not getting, fully baked financials. If we get a login to QuickBooks, that's probably a good day for us. And so right, we're in the trenches here. And so when we tell a seller, hey, first of all, we have to keep all their people, right? Have to, because if you lose one person in one functional area in a lower middle market company, you're in a world of hurt for a while until you can replace that person. So when we say to our LPs, listen, we're going to get in there and dig in and be operational focused, we don't have an option. You have to do it, because if you don't, you're going to get in a lot of trouble really fast, especially when you talk about, sub 5 million EBITDA companies. So I do think there are sponsors out there that, will say that they're going to do something and maybe they just don't do it because they don't have the time or the bandwidth at their shop, or they simply just haven't had this experience in the lower middle market. I don't know if that's fair, Alex.
Yeah, that's fair. And if you're buying a company with a few million of EBITDA, 2 or 3 million of EBITDA, and then you've got debt service now on top of that, it's not like you can go hire an army of McKinsey guys to come help you post transaction to go, do IT integrations and go run your playbooks for you. You don't have the free cash flow to do that. So really it comes back to the sponsor to be able to execute on all the things they've identified pre-transaction to actually go do. And so, yeah, you hire third parties here and there, but really all the work is on our shoulders, at least in the deals we get into.
And guys, wasn't this sort of part of the thesis for Rise Run? Not any of your individual portcos, but for what you set out to do. As I recall the story, the beers in Wyoming, you Alex, you were a QOV provider, so you had this perch where you'd seen a lot of private equity and seen where there was a gap in performance, right? That there was a lot of talk and not a lot of execution. Was it? Say more about the kind of origin story of the firm and how it relates to what this theme we're on.
Yeah, I mean, as a service provider in the lower middle market, worked on, countless, I don't even know, hundreds, thousands of transactions over decades. But you got to see, I got to see, because we did a lot of QV work. We did a lot of post-transaction interim project work. We did a lot of strategy work. So we got to see sort of full life cycle when I was on the advisory side. And, I think some of what we're alluding to, at least me, is that you guys say they're operationally focused. And I don't think many people even understand what that means. A lot of guys will buy a company, tell the CEO to do a few things, and then show up at the board meeting 3 months later and see what happens, right? And then things go right, things go wrong. I saw that repeatedly. I saw that happening repeatedly with guys that say we're operationally focused. They give the CEO a couple of orders, and then they then they go work on the next deal, right? It's a lot of deal stuff, not a whole lot of like value creation stuff. So I just said, Corbin, like the things we identify and the things that we see in these businesses that need to be fixed or need to be addressed or improved or whatever, like that's on us to do that. If we say we're going to do it, if we tell our LPs we're going to do it, and we tell ourselves we're going to do it, we better go do it. We better be able to go do it ourselves. And I think that, I mean, when we say, we say we do what we say we're going to do, like we pride ourselves in that. Like if we say we're going to do something, we're going to do it. And I just, I don't think that happens across the universe.
Yeah.
Mhm.
And then to piggyback on what Alex just said, the cadence of our deals, we've done one platform transaction a year. And so that's kind of the cadence that Rise Run is on in our strategy, because it takes, post transaction, it takes us about a year to really get a company in the right trajectory that we want to see. Obviously we can't just do one deal and watch it for 5 years. We have to, have a portfolio, but it takes that 12 to 14 months to really get the strategy down, really get the company humming. So
Yeah.
I think that kind of aligns with what Alex has said. Is if you look at our history of our firm, we've really followed that strategy.
Corbin,
Yeah.
Well, I don't feel like that's a particularly slow cadence, though. One a year for an independent sponsor of your size.
So, Will, I would say, I would agree with you on your average independent sponsor. I would call Rise Run a more mature independent sponsor. Um, you know, Alex and I could have a fund right now if we've essentially elected not to have one, because our strategy, it's very difficult to deploy capital that quickly, right? If you're looking at proprietary deals and you have a decent sized fund. So I would agree with you that, maybe one a year is a pretty good clip. We have six guys in our shop now helping us out. So we do have some bandwidth. Again, try to focus on the company for a good amount of time post transaction.
Yeah. No matter how much diligence you do in the lower middle market, it doesn't matter how much diligence you do, if we do, there's always something missed every single time. And this is 100% true across our entire portfolio. Something always gets missed. And so that's why it always takes 12 months because you figure out what the miss is, then you address the miss, right? Then you refine your outlook, you tweak the plan, and then it just takes 12 months. I mean, on one of the businesses, the technology kind of business we own, I mean, we had third-party code diligence done. It cost us $100,000. We close on the company. 5 days later, we find there's something wrong with the code. And it's just like, it doesn't matter what you do, you're always going to find something. You just can't find everything in diligence.
Yeah.
Yep.
But guys, you have across 6 years of doing this with Rise Run Capital, you've acquired 5 platforms. You've had 1 exit. You've done add-ons within that portfolio. You talk about a 1-year post-closing, highly intense integration period, and you're operationally hands-on. How do you find the time for all of this? And how do you split your time if you look at 2026? How much is transactional versus operational?
I mean, we're the active CFO at 2 companies. So, I mean, we are literally, when we say we're involved day to day, we are literally day to day. Sometimes we're in QuickBooks making transactions. Sometimes we're running the monthly financial reporting, right, for the banks. Like, we are doing it ourselves. Every day is something new. I mean, recently, post exit, and I don't know if you want to get into this or not. We actually started a company last year. It's a manufacturing business here in town that has sucked up a lot of time, and we are at the factory, all the time. And so, it's hard. We've got a great team. We have phenomenal associates. But
you
once
mentioned
you
you have
past,
6 team members. What's the lay of the land there?
Yeah, we've got 2 associates that have been with us for almost the whole time now. We had one guy made a grave mistake and left us, and he realized his mistake and he came back a year later. So we got him back. We have,
And you're still shaming him.
we're still, and we'll never not shame him. I told him not to leave. But he came back. I mean, they're like A plus players. They're just phenomenal. We've got an in-house counsel that, half deal guy, half counsel, and then we've got an in-house basically BD guy that's just out pounding pavement for us. So a small but well-rounded team at this point.
What are the last 2 roles? I think that was 4 out of the 6.
And then two Corbin and I.
Okay,
we count ourselves.
So including yourself. Yeah, okay.
Including ourselves, yeah.
And so you focus there a little bit on back office with legal, but mostly front office and people who can help with transactional work then, right? Or do you really deploy the associates into the companies as well?
They're in the companies.
Yep.
They're full-time in the companies.
Are you close to your max cap with the current
Yes.
structure?
Yeah, we are. If we don't sell a company this year and we acquire another one, we will have to hire somebody. Yeah.
Corbin, you said we obviously can't just have one deal for 5 years, but that is the model of a lot of not only search funds, but also a lot of buy and build and roll up guys who will, exist with one platform only. Why do you contrast yourself to that, or why is it obvious to you that you should not follow that model?
Well, the search fund guys, I think that's a whole different model, right? You essentially have one or two guys, and they're focused on just that company, and frankly, they're in the C-suite of that company. And then our firm, I would consider our firm somewhere between an independent sponsor and a full-fledged fund at this point. And so, we do have the bandwidth to do one major platform transaction a year. We've done 4 add-ons in the last 6 years to various platforms. So we, obviously Alex and I work really hard, but I do think we have the bandwidth and the capability of doing this. And I would say, and let me back up for a second, when you say sourcing new transactions, the huge value that Alex brings to our firm is, when he's done 2,500 QFEs in his life, when we see, SIMs or I would call them broker docs, or even just having lunch with somebody that knows about a company, Alex can really vet out companies very quickly. So we get to a quick no very quickly. We probably look at 500 companies a year. We boil that down. We're boiling it down to a funnel. And I would say we issue maybe 10 LOIs a year, and we will execute obviously on one, or get to the finish line on one. So yeah, I think right now we're probably, right at the right amount of capacity and bandwidth, but I agree with Alex. We will be growing here pretty shortly, given the pipeline that we have in front of us.
You've said that you opted not to be a fund, but your mature sponsors, at some point, your deal flow or deals you want to do may outstrip your capacity. Do you see the 5 and 10 year vision of this as growing into as much good deals as you can get access to, or do you want to kind of hit a cruising altitude that you stay at?
I think probably the latter. So the fund model, a lot of our investors really don't want funds. They want to be able to analyze and ride along with us on these transactions. And then, the fund itself, right? If we're proprietary deal guys and not industry specific, Alex and I like to invest all up and down the capital stack, and to have those parameters in a fund is probably difficult. And then the other thing is, if you raise, let's say, a $200 million fund, it would be somewhat difficult to deploy that capital within a time frame, given the good proprietary deals that we're looking for. So I would say our firm is somewhat forcefully we're trying to stay low in the lower middle market, because we believe call it 3 to 7 million of EBITDA. We're good at taking those companies to call it, 10, 12, 15 million and then exiting. What we're not good at is brokered processes that is, 10 plus million of EBITDA. There's 30 folks chasing them. You win, and we've never won one, but if you do win a brokered process, we don't understand what you're winning. We don't, unless you have an amazing strategy for a company that you pay 12 times for, or 15 times for, you better know exactly what you're doing or you're going to get in trouble. So Alex and I, our strategy is to stay low, and really get to the sellers and have one-on-one conversations with them.
Yeah, and it would be very difficult to deploy 50 million a year or more into proprietary deals. But like our deals take, I mean, the average runway for us when we meet a seller, and if we ended up transacting, I mean, it's 18, 24 months. And there's pros and cons to that. I mean, obviously the pros are we win at the closing table because we haven't paid more than 5 times for any deal that we've gotten into. The pros are we get very, very long inside look at a business and an industry before we ever have to pull the trigger. So if anything goes wrong financially, if there's some industry risk that surfaces over that courting period, we pull the trigger and we get out. We just eject. And in a process, you've got 60 days to figure this out. And with our processes, we've got 2 years to figure this out. And so on the flip side, we just don't deploy capital very fast because it takes us that long. You've got to develop a relationship with these sellers, right? You've got to tell them why you're different and better than the other guys. That takes a long time. That's multi months. Then you've got to negotiate against them, right? So now you're friends with them. Then all of a sudden you're submitting an LOI and they hate you because they didn't get the valuation they wanted. So then you got to go through that whole song and dance for the next 3 months. Then you got to do diligence on your own without a middleman. So you become an educator, right? Then you have to procure all of the data yourself. It's just our preferred process just does not lend itself to being in a fund. Nobody would give us money to do that. If we told them we were doing that, they would never give us money. That's why we just do our thing. We have a good deal. We bring it to our guys and they fund it.
Yeah. Well, the real benefit to this is by the time an LP sees our transactions, it's fully baked. We've done the diligence that's required. All third parties diligence is done. And like Alex said, we really hone in on the industry, make sure we have good, market studies done. So on our side, it's a lot of work up front, but I would say from an LP's perspective, if we bring you a deal, it's pretty much fully baked at that point. So that,
Corbin, what do you mean by fully baked? When you say that, what does a deal look like when you first send it to an investor? Which materials do you send? And exactly what you mean by fully baked.
So let me put it in 2 different categories. One, I would put the institutional investors of ours. A lot of the institutional investors want to see it probably right post LOI. So they want to ride the horse with us. They want to go through the QOV process, market study, right? Or high net worth individuals or family offices. The vast majority of those folks want to see, obviously not only the LOI, but right, they want a fully baked QOV, a fully baked market study of our own SIM, right? When you do our own proprietary deals, we can't send them a SIM from an investment bank because there isn't one. So we're doing the whole memorandum. And so when I say fully baked, that's what I'm alluding to.
So you socialize the deal quickly post LOI with anchors and lenders, but for gap equity providers, high net worth individuals, you wait until later in the process when the sources and uses have fallen into place, the diligence is more or less completed, and the deal is happening within the next, call it 45 days.
That's right. Yeah. And we've had a very good experience raising equity. On one of the transactions, I think the one that we just mentioned that we exit, we raised all the equity in, I think, 36 hours. So when our investors see something from us, they know that we've put a lot of time and effort and thought into our product. And so, yeah, that's how we want to make sure we're presenting our firms that we have the answers to their questions before they write a check.
Alex, 2,500 QOVs as a QOV provider. And you say that the deals you do, you spend 2 years of diligencing, and the deals you don't do, it's a quick no. Can you share more about what's a quick no, and what are some of the hard criteria that you use in order to get them all the way to the finish line, and what really excites you?
Yeah, I mean, we have some like really strong, I mean, preferences. I wouldn't call them like check boxes, but strong preferences. We like local businesses in Texas. If they're here, it's just easier for us to be there. It's easier for us to help and participate. Not to say that like you can't fly anywhere in a couple hours. It's different, right? Travel is just different. We have a wide fairway, right? We cast a wide net because we don't have the luxury of picking and choosing highly focused, strategies around whatever healthcare tech. Like we have to be able to see like if we can wrap our heads around an industry and then get down at the company level and go, where do these guys fit in? What do the people look like? Are there immediate growth levers that we can pull? And really, we're super focused on growth. So if the industry allows it, and the company, is in a good position to grow, and we think we can pull those growth levers, it really doesn't matter to us what industry they're in. If we can identify those things like early on, we're interested. And we've got some other criteria. I mean, like, if the CEO gets hit by a bus, can we step in and run the company type thing, right? So it's got to be simple enough for us to understand, like there can't be too many moving parts, basic things, service industries, you're servicing something, you're making something, you're selling something. We can wrap our heads quickly around those things. I would say those are like pretty hard and fast rules, although, every rule is made to be broken. We've got an investment in an organic dairy farm, which is the largest dairy farm in Texas. We broke all of our rules, but it's been a fantastic investment. And it kind of fell into our laps, and we have one single large LP that we're basically managing it for. And so, look, that's the beauty of being an independent sponsor. We have rules, but like if there's situations that are super interesting and they make a lot of sense, and we can spend a lot of time diligencing them. I mean, like I said, 18, 24 months, then you can get comfortable with things, even if they don't check all your boxes. And that, frankly, that's what we did on the dairy.
Yep.
Alex, it sounds like all of that experience doing QOVs doesn't mean that you have a whole different list of check boxes. I know we don't like that term, but different check boxes than the rest of us do. But maybe you can home in quickly on a business's weaknesses faster than the rest of us. So it allows, because you just have such muscle memory. Yes. It allows you to screen businesses at a higher rate than maybe the rest of us mortals can, sort of thing.
That's right. I mean, dealing with lots of 2,500 QVs, dealing with 2,500 sellers, you can size up sellers pretty quickly. You can size up businesses pretty quickly. We did a lot of healthcare stuff back in my QV days. Like you could, so we haven't done any healthcare though at our firm here. But yeah, I mean, we look at a deal quickly and we go, this is interesting or this isn't. Here are the 3 reasons why. And if it's interesting, then we embark on a 18-month journey.
I recall you guys saying that you needed to see like 3 clear growth levers to your point of focus on growth. You needed to be able to identify to yourselves 3 very clear levers that could generate growth in a business before you proceed.
Yeah, 2 or 3. I mean, 2 or 3. We always look at pricing. We look at where whatever they're selling, whether it's a service or a good. Like we look at pricing. We ask ourselves, is there room for pricing optimization? Is there room for product optimization? Is there room for market share growth? Is it not possible? Is the industry growing? Is there room for everybody to grow? And so we take a deep look at all of those things. And if we can pull 2 or 3 of those levers, then we get super excited because, pulling levers are the fun thing. What we don't want to do is get into a business and now you've got debt service. Now you've got You've got a whole other thing, concerns to deal with. Like you just better be sure that you can grow the business when you get into them. And so we're super hyper focused on making sure the businesses can grow post transaction. If we can't see them, we're just not interested.
How disciplined are you on the front end with valuations on the entry multiple side?
Extremely. Yeah, I mean, in the lower middle market, for sellers, right? A lot of these sellers, we require them to roll 10 to, I don't know, 30% roll, right? And obviously they're want the highest price at the end of the day. And they're worried about leverage. We're low leverage guys. So we can basically explain to them, how leverage is not going to hurt them. But the other thing too is, for a second bite of the apple, you need to enter these transactions at the right price, because you need to have the capital to grow them, first of all. And second of all, the expectations of the seller for the next bite at the apple. So you have to remain disciplined, Nicholas, or we've seen a lot of sponsors get in trouble, right? If you overpay, especially if you're in that 3 to call it 6 million of EBITDA, you can't be paying 10 times for these deals. It's just not feasible.
But you're a growth investor, right? That's what Alex is saying. In order for him to be excited, he needs to see at least 2, hopefully 3 or more avenues to grow fast. Wouldn't that enable you to be more flexible to pay 6, 7x or more on your deals?
No,
yeah.
Well,
hypothetically, yes. On paper, yes. But philosophically, we are very allergic to not winning at the closing table. We want 50% of our victory to happen the day of closing. So like we've got so much cushion that if something goes wrong, like it's going to go wrong. We've got time to fix it. We haven't overpaid. And by the way, when you overpay, you're overpaying in the form of leverage. I mean, that's where the extra dollars are coming from. And so if you overpaid, you're overlevered, et cetera. We try to underpay and underlever. It gives us lots of cushion, gives us lots of times to work through problems, which they always happen. And then you've got then once you get everything on the rails, you go accelerate.
Yeah, I mean, on the seller's rollover, right? I mean, if you look at our companies, the seller's rollover, they're experiencing, call it 3 to 7 times their initial check, right?
Well, that's the hope, at least, right?
Well, it's a hope, but also you need to help the sellers to understand that you need to set up the next new co for that success. And if you pay 10 times, right, and they roll, call it 30%, and you lever it to the hilt, that one could argue their rollover investment's not worth what it's worth, right? And we don't want to play those games. We want to be a sponsor that's aligned with the seller and to grow with them. So we just want to set up the companies for growth day one.
But sellers aren't stupid. So one thing is you not overpaying, but they won't allow you to underpay either. So I guess you used the example of a broken process earlier in our conversation, that you just stayed persistently on it for a year without ever hearing back. And then when the time came, they were willing to talk to you at fair market value. But what are the keys to kind of landing fair market value?
Some of it, by the way, is when they're rolling and they're rolling meaningful equity, I don't know, 40%, 35, 40% in some cases.
Right.
Like they're also a buyer at that point. And so you convince them of that. Like you're buying 45% of this. You don't want to overpay. Yeah, you're taking chips off the table. But if you're really that invested in this with 40% retained ownership, you're a buyer. And your second bite with us is going to be a lot bigger. And by the way, that messaging works a lot well.
And then also, let's take 5 times, for example, right? If you invert that, right, if all things stay constant, that's a 20% return, right? From an equity standpoint, and you look at the market, who knows what the public markets are going to do, but call it 8 to 10%. If you're buying a $3 to $5 million business, that equity premium is not out of line in my view. If you pay 10 times for a business and you're returning 10 times on equity or 10% on equity, I mean, you might as well just be in the public markets at that point. So that's when Alex said, a couple months of education and aligning ourselves with the seller. That's really what we're here for. Now, that's not to say that some other buyer's going to come in and say, hey, we'll pay you 8 or 9 times. But again, I agree with Alex. The seller is actually reinvesting in a whole new platform. And you want to make sure that their investment has the greatest opportunity to, again, 3 to 7x at the end of 3 or 5 years.
And by the way, also, this is why relationships matter, which is also very different than like big funded private equity guys where it's very transactional. For us, if you start with relationships with these sellers, like it's much easier to get to a number that's fair for both sides.
That's right.
Versus in a process where nobody's seeing each other's faces. It's just numbers on a paper. Nobody cares. But when you're friends with someone or you have a relationship and they trust that you're going to do the right thing with their business, it's a lot easier for them to come down on pricing and understand kind of our perspective. It's just a completely different approach. It's just completely different.
Corbin, following up on your chatter there about returns in the lower middle market, what is your take on what the returns ought to be, kind of on average, middle of the fairway here for deals in the lower middle market? You had a previous job investing in this area as well. Alex, of course, had extensive experience, and then also across your portfolio. So what would you say is kind of like good, better, best returns wise?
Yeah. So, I mean, let's look at time horizon, right? A lot of things that we're underwriting, we're looking at 3 to 5 years. There's multiple reasons for that. One, taxes being one, but also just operational growth. So you're really looking at 3 to 5 years. And Alex and I have had multiple conversations about this in private, but we would say if you're in the lower middle market, you should be getting, call it 3 to 6 times MOICs, or at least underwriting it to that. If you're not, the risk that you take in buying these small companies is just too great without those type return. It risk adjusted, you might as well invest in something else if you're not at least gunning for those type returns.
And is that the range where you have seen deals land on average in the past?
So, we had our first exit. I would say it was well north of those type returns. If you look at our other 4 companies, those companies are on track to meet those expectations. So yes, I would say those are realistic. Now, not every sponsor is going to hit those. We're not going to always hit those. Mathematically, you're always going to hit some problems, and you're going to have some outliers on the low end, and you're going to have outliers on the high end. But I would say if you take that kind of, distribution bell curve, and you put it right in the middle, you would say, 3 to 4x MOICs over, 3 to 5 years.
So 3 years is a pretty quick time frame, right?
It is. I say 3 years, and we can get into this, but with the 1202, and the big beautiful bill and the tax changes, you get 50% of the tax deduction at year 3. And so if you did have a really high flying company, you could hold on to it, but also if there's, a good exit opportunity, if a strategic came in or, some other really good opportunity, 3 years is not a bad hold given the tax benefits.
And also, we like to leave meat on the bone, right, for the next guy. I mean, I think it's just as much as you're selling a company, you're selling a story, right? And if you hold that thing for 5 years and you've been growing it for 4 years at 30% a year, and in year 5 you only grow at 10%, by the way, you've just destroyed value. You just destroyed a turn or 2 of multiple because you wanted to hold on to it for another year. Like, we're not greedy. If you can get a big win early, and like if you can get a 3 to 4 times return in 3 to 4 years, like, you should be taking that every time.
Guys, you're $40 million of EBITDA in the now 4 portcos. So a lot of that EBITDA has been growth under your ownership. Can you give us a sense of, or maybe a couple of examples, or a sense of what the aggregate EBITDA was on entry across those 4? I mean, I'm trying to tease out some of the growth that you've generated, not just in the one that we already heard about that you exited recently, but in some of your existing holdings as well.
Yeah, maybe I can go through it on a no names basis here, but for one portfolio company, we bought the assets of the company and really didn't pay a multiple on the EBITDA itself, and we've probably grown that EBITDA from 5 to 7, call it, or 8. Um, One of the companies we own has gone from 2 to 11 million of EBITDA. It's been vast majority um, vast majority organic. We are doing a $4 million EBITDA add on to that business right now. Um, and the one that we're invested in right now, I mean, that the latest one, it should produce, 5 to 10 million of EBITDA this year. And then one of the companies we own, um, it's somewhat weather dependent. Um, and, it'll do 10 million of EBITDA on a core business. But when the wind blows, it'll do, 3 times that. Um, so we've had really good organic EBITDA growth in our portfolio. I think it does go back to, being operationally focused on these businesses, also making sure that the C-suite or the right folks are in the right seats. That's a huge thing. And also our firm, we're not sharp elbowed private equity. Private equity unfortunately has some bad connotations amongst sellers. We are truly collaborative with our company. So I don't know if we had the secret sauce down or if it's luck or what have you, but Rise Run has done a great job over the last 6 years, and so we're just trying to repeat exactly what we've done over and over again.
And it sounds like organic growth of EBITDA is what you've done more than buy and builds or programmatic M&A. It doesn't sound like that's in your default playbook.
We
Yeah,
haven't done that yet. We have an opportunity we're early innings on. That would be a kind of our first real roll up, where there's a pre-baked pipeline of M&A that we would chase. It'd be a race. But yeah, no, you're right. It's organic. It's organic focused. We've added strategic M&A along the way. So that, some of that strategic M&A drives synergies, right? And those synergies they can accelerate the organic side of it too, on both sides. And so, yeah, I mean, like on the tech business we own, it was a lot of, it's a lot of product optimization, pricing, just getting a lot of little things right. And by the way, we could never do this with that. And just as a quick comment, we've had infinitely more success with our second CEOs than the sellers. If the sellers are staying on board and they're the CEO, we've almost invariably, Corbin, have replaced them, right? At this point,
and I think in a lot of them, and to give credit to the sellers, right, that they are very good from starting a business and getting it to 4 or 5 million of EBITDA. They're and after about 12 to 18 months post transaction, they realize that they're probably not suited to go from, call it 5 to 15 million of EBITDA, and that's fine, right? They have rollover equity; they'll benefit from it. But we've had extreme success with the CEOs that we've brought on, and all of them are collaborative with the sellers, right? They're very similar to us with being collaborative with the sellers.
So these are friendly transitions, then.
They're very, I don't think we've ever. Yeah, I don't think we've ever fired a CEO where it was not friendly. So, yeah.
And how do you recruit, since you have such a strong track record with hiring the new CEO? And what's the ballpark range compensation-wise to get the top CEO in the lower middle market?
So that's really interesting. So this goes back to what Alex had mentioned, that our the timeline from the time that we meet a seller until we close. We really dig into the industry and we look for operating partners. So operating partners in our world might be just as important as good targets, right? So we have a long runway. We really like to have someone, by closing, they're not going to be CEO day one. They'll probably be, chief operating officer or an operating partner of ours. hopefully they diligence the deal alongside of us, frankly, and get some really good industry expertise. On compensation, it really runs the gamut. You know, a lot of this, we have very good incentive pools, right? So the base comp and the bonus is probably not as high as, you know, some larger companies, but they definitely they have a meaningful stake in the company. The company we just exited, our CEO did extremely well. He, you know, frankly, could retire if he wanted to. I don't think he's going to, but yeah. So the compensation is a mix of base, obviously salary and bonus, and a very hefty, I would say, Alex, very hefty equity program.
Yeah, I mean, for example, I know we're over market on our MIP plans. Like our CEO at the tech company, the fundraising company, he's got a 10% MIP and he has all 10% of it. Like it's already been awarded to him, type thing. Same thing with the ag business.
Yeah, that is very high. I sometimes hear 3, maybe 5%, but 10,
Mm-hmm. Yeah,
10% stock options or ownership is high.
I would say those two companies, those two leaders are
unique,
extremely valuable to the company. I would say on average, you know, we have a 10% MIP. The CEO is usually taking 3 to 4%, somewhere in there. And then, you know, you got onesies, twosies for the rest of the C-suite. But yeah, it's, but our first exit, I'm really happy for him. And, you know, we paid out, bonuses to the entire team. So everybody won in that transaction. And that's really important. It gets back to culture, right? I know culture is not always, you know, a lot of private equity guys think it's kind of a fluffy term, but it's in the lower middle market it is extremely important.
Guys, I think that's a good place to leave it. It's remarkable, your success so far. Congratulations on the recent exit. Congratulations on all the EBITDA growth and the businesses that are still in the portfolio. It sounds like you can, you know, gin up LP interest. I think 36 hours, you said, Corbin. So if you add us to that list, we'll make sure to get back to you in 24 hours. We hope you'll include us on future deals, Minds Capital. But really, guys, thank you very much for coming on the Minds Capital podcast. Congratulations to Rise Run's success to date.
Thank you very much for having us, gentlemen.
Thank you.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.